Hello everyone and welcome to the Naked Puts and Calls video tutorial here at Option Alpha. Now the Naked Puts and Calls strategy is far and away one of the best building blocks that you could ever have as an options trader. And again, I say that all the time to our coaching students that we have, but it really holds true. It's the only option strategy that really takes advantage purely of time decay of the value of the option and really allows you to get far from the market and limit your risk exposure. So here on your screen is a payoff diagram for a sold or short put option that we have written. And so this is a great example of how the payoff diagram works. Now I know that puts and naked calls get the stigma of having unlimited risk, meaning that your negative side is really unlimited to the downside. Now again, technically that is correct, but have you ever seen the market drop to zero? Have you ever seen the market jump up 700 points in one day? And the answer is really no. So even though it technically has an unlimited risk feature, we trade so far from the markets and so far out in our trading that the market would literally have to make a once in a lifetime move for us to ever lose money on these trades. So again, they are the most profitable trade that we have here as far as consistency, and that's why they make such great building blocks for options traders. So in this payoff diagram, you can see that we have again here the stock price on this horizontal line, and this is a stock price of 45 and 50. This particular put option is sold with a strike price of 45. You can see here that the profit, if the stock closes anywhere above this 45 strike price, is $200 that you get to keep in premium. So let's take a look at a chart and see how this relates to a chart. Okay, so here's a really good example, and this is just a general stock that we picked out at a certain period of time of selling a put at, let's say, 45. So now we can also sell calls above the market, but let's use this same example we've been working with of selling a put at a strike price of 45. Now you can see that if we sell this put at a strike price of 45, the market would basically have to crash here and close below our strike price of 45 at expiration for us to lose any money. Now this is a lot different than most traders who try to buy options, they try to buy a put or buy a call, and what they need is they need a major move in a short period of time to even make a little bit of money. So what we've done as option sellers and option writers is take the opposite trade. We are now the ones selling the option to those people, selling the put, selling the call, and what we're forcing the market to do or forcing the stock to do is make a very dramatic move in a short period of time. And the chances of that happening are really, really slim for most of these things that we trade, and particularly the indexes. The chances of them making a 20%, a 25% move in a given month or expiration cycle are virtually slim to none. So while these options are in themselves a lower value, the fact that they have an increased probability of success makes them a really great trading tool for any type of options trader. So again, if we had sold this put down here at 45, the stock would actually have to drop all the way down to 45 and beyond by expiration. Now the beautiful thing about the naked puts and calls strategy is that we can actually leg into a credit spread in case something happens. So that really is our backdrop, our safety net, if you will, for risk in this portfolio. Again, this has been the Naked Puts and Calls video tutorial.